Hey, this is Ray. Wanted to go with you, go over a couple of things. This is May 1st. Share with you uh, the anatomy of a trade and how we might go into actually constructing a portfolio using our Power of Two methodology. Of course, as you may remember, the Power of Two is using two engines to profit, not just direction, but also volatility. And we have to start somewhere, and so the first place we want to start is picking some core holdings that we would like to own kind of no matter what. You know, we've had a nice market. Volatility has started to pick up, but we want to be, you know, if we're looking at a 3 to 5 year time frame, which is still kind of a conventional way of looking at things, to buy and hold, we want to own things that we're okay with in the event that we get a correction. And so I've chosen those five holdings, at least from my particular um, belief set, and here they are. Apple's number one. Apple is I think the preeminent tech stock. Actually, they came out with earnings here today after the bell, and their earnings have them up about 6.11% after the bell. A lot of good news around Apple. I think the future for Apple is in terms of how they use their cash for acquisitions, but I believe Apple is a great core holding. As far as, and that's a tech stock. I think that's one of the best tech stocks in the group. That's not overvalued. Then you have Goldman Sachs. Goldman Sachs, I think, is the preeminent financial player. I think they are ripe for higher prices. They are currently down 7.10% year to date. They have a dividend of 1.35%, but they are the best in class when it comes to the financials. I would own Goldman Sachs. Third core holding would be Chevron, oil and gas company. They are certainly the best in breed also. Chevron is down. They're actually flat, down 0.26% year to date. They have a 3.6% dividend yield. I like Chevron. I like oil and gas. I think Chevron is certainly best in breed also. The next one has a little bit of glitter here. It's a biotech stock. It's a good name. It's a blue chip name in the biotech sector, if there is such a thing. Currently an $87.87 stock. It's down 15, almost 16% year to date. No dividend, of course, but biotech is something that can hit a home run. And I think it's a good it's a good something. It's a good position. It's a good holding to have in a core lineup. Next in the industrial space is Caterpillar. All of these are best of breed. Caterpillar is 144.42 at close on May 1, down 8.35% year to date with a 2.16% yield. You can see all that information right here as of the close of business on May 1. The good thing about these core holdings is that it correlates, I don't have the numbers exactly, but somewhere close to 85% of the S&P 500. So as the S&P 500 goes, so will a portfolio with these only five stocks, which I think is a good thing, because if we have something with a high correlation to the S&P 500, we have an easy way to hedge risk should we have to, with SPYs as an ETF, or any number of vehicles available to us to be able to hedge. So I think this is a great core holding. If somebody's asking me to say, hey, okay, let's look at Apple, and let me show you kind of how this works. We've got Apple trading at 169.10, and like I say, it had earnings out today here. But let's say we wanted to sell the puts at 162.50 going out 30 days. We would collect $2.63. That's one contract controls $100, as everybody I think might understand. And so that means if we're looking at, say 5,000 shares of stock to initiate a trade on, that would be 50 contract. 5,000 divided by 100 is 50 contracts. One second. Okay, so if we're looking at Apple and selling a put, there's a couple of things that we look at. It's currently trading at this level here where the green dot is at 169.10. If we were to sell the 162.5 puts and we wanted to control 5,000 shares of stock, we would sell 50 contracts. 50 contracts times $263 is the amount of premium we would collect. That's $13,150. What's great about this technology is it spits out what your probability of profit is on that $263 credit, and it's 74%. So 74% of the time we're going to profit off of a trade like this. That is pretty cool. If we wanted more than that, 87% would allow us only $1 credit, which makes sense. You get less credit for the more probability that you might have. Generally speaking, what we want to do is we want to put these trades on when volatility is high. That rewards us with the most credit and gives us the most potential movement that is least likely to happen. If we wanted to look at Goldman Sachs, we can do the same thing with Goldman. We would go in and we would look at the curvature of the risk-reward area here, and what we're going to notice is that these dots give us what we call one standard deviation. Anything within this range is going to allow us a 68% probability of seeing it happen. This wider range is a 95%. So if we wanted to sell the puts going out, let's go out further than 23 days. If we went out, generally speaking, we want to go out about 45 or 50 days to get the best bang for the buck. So if we do that here, that's 37 days, that's $2.63. That's an 80% probability of occurring from this particular point here. I love it. The technology is awesome. Now let's look at how a spread might work. Selling puts to own a stock is a great thing to do. Selling calls once we own the stock is another good thing to do. Before we roll to that, let's go in here and look at selling a call. If we go out again around the 44-day period, we can get $3.62. So that means every time we do something like this, if we buy the stock at $2.36, we can reduce our cost, our investment basis by $3.62 down to $2.32.38 every time we do it. And if we look at this, this will tell us, I'm going to get rid of this leg, that there's a 74% probability of seeing that happen in the next 44 days. We can run out and give ourselves a higher probability for less premium. That's exactly how it works. Nobody should ever operate without the idea or understanding of how probabilities can inure to your favor and what they say based on the markets. Now we're going to look at a credit call spread and see how it works. Without owning a stock, we can actually go out and we can sell the calls. I'm going to continue to stay in that 44-day area, and if we sell the 175s with the stock at 163, basically we would be obligated to short that at 175 plus $1.85. So we would have a short interest of 176.85 when the stock is currently at 163.14. If we were doing a credit call spread, what we would do is define our risk. And the way that we would define our risk would be to buy a subsequent call at an interval that's higher. And so let's say that we go out to the same time frame, which is 44 days out, and we decide that we're going to have an increment 10 points higher. That means that for every contract, we're going to risk $1,000. If we risk 50 contract, if we do 50 contracts or 50 credit call spreads, that's going to be $50,000 risk in order for us to make $255 times 50, or $12,750. So if we were to divide $12,750 divided by $50,000, we're risking $50,000 to make $12,750. That's a 25.5% return, and versus a calculation here that's an 81% probability of seeing a profit. So credit call spreads are a great way to trade the short side. Define your risk, because on shorts you've got unlimited liability, and you don't want that necessarily. And so you could define your risk maybe to only 5 points if you want. You're going to still have a high probability of return, but you're going to minimize your credit spread. Actually, I did that wrong, didn't I? Hang on one second. Okay, this is how that works. So you're going to be short a call with a $5 incremental risk on. So at 50 times, that's $500, $25,000 risk. You're going to collect 88 cents or $88 times 50 for that. That's $4,400 on that risk that you would get 78% of the time. Or you could go out to 10 points and you collect a higher credit, which is $1,000. That's going to be your $50,000 risk in return for $140 times 50, or $7,000 return. So $7,000 divided by $50,000. Why would you ever risk $50,000 for $7,000? Well, in this case, it'd be to make 14%, 79% of the time. That's how that works. And we can do that on Red Hat. We could do that on Square. We can do that on Shopify. We can do that on Tesla. And isn't the technology cool that spits out what your probability is? One of the things about stocks is, and these types of instruments, is that people will say, hey, this stuff is risky. Well, it's risky because most people want to buy low and sell high. We're selling first, and we're generating premium off of that, and we're taking a high probability for return because it's out of the money, and the market's got to move a significant amount for us to be at parity or be at a loss. That's it. I'm signing off, but I would like for anybody that has any questions to certainly give me a call. Thank you.